The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, I'm Jason Nickerson, Executive Vice President, COO, and this is Financial Focus. Welcome to the pilot episode of Financial Focus, where our objective here is to discuss current events, current financial events, and top-of-mind topics in a straightforward way, providing information and even some options and strategy for you to consider. In this first episode, I want to cover that time of year again where it's early March, and on top of all of our minds is income tax preparation, both as professionals and as tax filers. Now, some of you may have already filed your tax return. I would still encourage you to listen in anyway, and maybe there's some information that will be helpful. So one of the big questions we're getting right now is, what is still deductible on my tax return? And it's an interesting question because there was a major change not too long ago, but not too long ago means a federal law that was signed into place in 2017 called the Tax Cuts and Jobs Act, TJCA. And the foundation of this law really was to try to simplify your tax return. And ultimately what it did was create years of questions of what is still tax deductible and what is not. So let's work through that. The law was signed into place, like I said, in 2017, and eliminates or limits many deductions through December 31 of 2025. And ultimately it was a simplification process that started with a significant increase in the standard deduction limits. The idea behind this was that if we increase the standard deduction substantially by almost doubling it, then a lot of taxpayers do not have to account for the number of deductions that they have and provide those to their accountants. So what did that mean specifically? Well, where we are today, and I'm just going to talk about the very foundational standard deductions, those under age 65. Once you get over 65, there's some adders and for other situations as well. So for 2022 on your tax return, single filers can take a standard deduction of $12,950, married filing joint $25,900, and head of household $19,400. And we already have the 2023 numbers. Single, it's $13,850, married filing joint $27,700, head of household $20,800. Now we don't need to memorize those. We can always look those up, but that's the starting point to understand that with a significant increase, almost a doubling of some of those numbers, that we don't have to account for number of deductions. The other thing to note is that we were able to, prior to this federal law change, deduct people on our tax return in the form of personal exemptions. So the taxpayer, spouse, dependents, children, etc., there was a dollar amount, roughly $4,000, that you could subtract off of income per person. Those are no longer. Now let's get into what is deductible, right? The question at hand is, what can I still deduct? Well, a lot of the deductions are still available, but again, only to the extent you get over the standard deduction. So medical expenses, mortgage interest, home equity interest, charity, taxes that you pay in the form of income tax or real estate tax. These are all still deductible, but you have to check your limits because there are hurdles and adjustments that were put into place with this tax law. What can you no longer deduct? Moving expenses, tax preparation fees, investment management fees, hobby losses, alimony, theft losses, and the big one we get the most questions on is unreimbursed job expenses. These are the expenses where if your employer did not reimburse you for, say, travel or taking a client or a customer out to a meal, that you could then deduct them on your tax return with certain limitations. Those are no longer deductible, okay? Also in the category of still deductible, but again, with some adjusted rules, casualty losses for federally declared disaster areas are still deductible. Gambling losses to the extent of winnings, student loan interest deduction is still deductible, and unreimbursed teaching expenses that are incurred by teachers in the classroom, okay? So there's still quite a bit that is deductible with adjustments. But again, the whole underlying theme of the law, of the federal law, was that if your deductible expenses didn't add up to more than your standard deduction, no need to do the accounting. I will put in place a big disclaimer, however, because that's a federal law. There are state laws as well that are different. And we here in New York are a prime example. New York State offers itemized deductions on their tax return, and they're very similar to the federal itemized deductions. So just when you thought you could get away from doing the accounting for your federal return of those deductions, you might still have to do it for your state. Thank you everyone for tuning into this week's episode of Financial Focus. We'll see you next week.